So in the previous video, we went over what it's like, buying options. In this options 101, we're gonna go to it's like selling options and why it's kind of a long-term trading strategy for long-term investors and why actually people do it if you know what you're doing. Now, taking a look at this example, we're gonna still assume a share of a stock is $100 per share. And in the first example, we're gonna look at what it's like selling a $110 call. Now, when we went over buying a $110 call, you are buying the rights to buy that stock at $110. Now, in this example, we're actually selling those rights to someone else for someone else to buy 100 shares at $110. Now, when you sell it to someone else, they're gonna pay you a premium. They're gonna pay you the intrinsic value plus the extrinsic value to you, and you get to keep that regardless of what happens. So you profit initially from that. And basically for this position, you actually do need collateral. So your collateral is, if you had 100 shares of this stock you already own, then you post that as collateral. That way, when someone else ends up buying it, if they choose to, then you're basically just giving them their shares you previously had. And at that point, you're also profiting on your shares from the value of 100 because you own 100 shares at $100. And if it goes to 110, you're still profiting that $10 move. But anything after that $10 move, if someone exercises you, they keep those profits. However, you still kept that $10 profit times 100 plus the premium they initially paid you. And that's why long-term investors do it. You just sell a call, something like, any time frame, but just, I really don't think it's gonna hit that price. I do think it's gonna go up, that's why you own it, but you just don't feel like it's gonna go to that price. Let someone else gamble it, collect their premium. If it doesn't hit, you made free money initially. If it does hit, well, you're still profiting on the way up until that point. Now, let's look at it like, selling a $90 put. Why would we do that? Basically, when you bought a $90 put, you're basically buying the rights to sell 100 shares of stock you own at $90. However, now you are selling those rights to someone else to sell 100 shares at $90 flat. Now, when you do that, you're still paid the premium, so the intrinsic value and the extrinsic value, and you get to keep that regardless of what happens. However, your collateral here is $90 times 100, basically $9,000, simply because if someone wants to sell basically 100 shares at $90, well, you gotta buy those shares off of them. And this is a way long-term investors use, simply if, hey, they wanna buy shares of a stock that they really like, but they feel like, it's a little too pricey for them at the moment, they will sell puts at a price they're willing to buy 100 shares of that at, whether it's $90, $80, $70, $50, and until it reaches that $50 limit or whatever strike they put it at, they're collecting the premium. So they're basically getting paid to wait to buy a stock they like at a better price. And that's kind of what you need to know about selling options. But one thing to keep in mind is you do need the collateral. If you did this without the collateral, you are taking on that risk, that unlimited risk. For example, if you sold a call and you did not have 100 shares as collateral, well, if this somehow shoots to $1,000, you are on the hook for those $890 times 100, that stock went up. Whereas if you just had 100 shares of that stock, you get a profit on, that difference from 100 to 110, collect that premium, and anything above doesn't really matter. Your shares are covering that loss. So thank you for joining us in this video and see you next time.